Hey, welcome back. It's Nolan Matthias, and today I'm making not the video I expected to make because today I expected to make the April mortgage rate update, but instead, OSFI, the Office of the Superintendent of Financial Institutions, has thrown a big wrench in my video schedule by suggesting that they are going to change the stress test. And what that means is that people are going to be able to borrow just a little bit less. I'm going to tell you exactly what it means for you and give you a history of the whole scenario with respect to the stress test. But before I get into it, do me that favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 10,000 subscribers, where one lucky subscriber is going to win their monthly rent or mortgage payment for a month just for subscribing. We've had over 3,500 new subscribers in the last month. Thank you to each and every one of you who have joined us, and to those who have joined us from the beginning. And for those of you who haven't, go ahead, click that subscribe button. It's free, it's easy, it's definitely worth it. And if you do it, there's a chance you might win your monthly rent or mortgage payment just for subscribing. The definitive guide on how to manage your credit. Product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss the changes to the stress test, or at least the proposed changes to the stress test, because these aren't written in stone yet. You can pretty much rest assured that they're probably going to happen. But OSFI, the Office for the Superintendent of Financial Institutions, has suggested that they are going to make changes to the stress test for uninsured mortgages, and it'll likely be effective June 1st. So, I'll show you the headline first and foremost. Here it is, my favorite site for this type of news, BNN Bloomberg. OSFI proposes tighter mortgage rules amid very strong forces. If you go through and you read this article, you'll see that a lot of what they're talking about is the security of the financial system in Canada and making sure that the financial system is safe if interest rates were to go up. And that's the premise they're using for these suggested changes. However, the real writing on the wall, and what you can pretty much rest assured that the real intention behind these changes is trying to cool off that $1 million plus market, that Vancouver and that Toronto market, by making it a little bit harder for people to purchase in those price ranges. So, let's start with the basics of this. What's the plan? What are they suggesting that they're going to do? Well, what they're suggesting is that instead of having the benchmark rate, which is basically the average of the 5 big banks' 5-year posted rate, as that stress test rate, they're going to move that away from the big banks and move it to a number that OSFI is going to set once a year in December. So instead of having it be 4.79, it's going to move to a 5.25 rate that gets relooked at basically every 12 months. Now, this is different than the way it was done before, the way it's been done for the last 4 years. For the last 4 years, they basically use the Bank of Canada's benchmark rate, which is the rate that is the average of the 5 major banks, and their 5-year posted rate. And there's a lot of criticism to this. Prior to COVID, they were actually looking at reworking this, although they expected that the benchmark rate was going to come down, not go up. Now that we're through COVID, it looks like they're going to increase the stress test, not reduce it. But the criticism was that the big 5 banks basically got to control what the benchmark rate was, and ultimately what the plan was to move it away from them, because when we saw interest rates come down pretty substantially, what ended up happening was the big banks left their posted rates quite high, which left the qualifying rate high, which led to some criticism. Now, I think this is good that they're taking it out of the big banks' hands and putting it in the regulators' hands. Now, as far as increasing it though, right now, I'm not sure it's a good thing for the market, and here's why. A 0.5% increase if we use the 1%, 10% rule, which the 1%, 10% rule is for every 1% you increase interest rates, you reduce buying power by 10%. Well, a 0.5% increase, which is what that would be, we're going from 4.79 to 5.25, which it's not 0.5%, but it's close to 0.5%. That basically creates a reduction in buying power on conventional uninsured mortgages of 5%. So what that means is on $1 million property, if you qualify to purchase $1 million property, after June 1st, when this rule goes into effect, you're only going to be able to qualify for about a $950,000 property. So not a massive change in how much people are going to be able to qualify for. However, what it is going to do is it's going to create even more fire and fury in the market leading up to June 1st, because everyone's going to want to try to get that property bought and that mortgage obtained prior to the rule changes coming into effect. So what OSFI has essentially done as of today is they have added fuel to an already hot fire when it comes to the Canadian housing market. Now, I get why they're doing this, because what they're doing is they're basically trying to make it so that people have to qualify at a higher interest rate, so that if interest rates do go up, they're more prepared for the higher interest rates and the bigger payments that come along with higher payments. Now, this is when we go into that variable versus fixed conversation. This is a big part of that conversation. We don't believe necessarily that people should be getting 5-year fixed mortgages, because if interest rates do go up, they're going to feel the pain of higher interest rates almost overnight. Versus if they were to have a variable rate mortgage, you feel it gradually as the Bank of Canada increases the overnight rate and subsequently prime rate. So, big reason to take a variable rate here is just in case those interest rates do go up. And so you feel the increase in payments gradually rather than all at once upon renewal. But, I think when you really think about what they're doing here, is they are creating a scenario that effectively has a pretty large impact on Vancouver and Toronto, $1 million plus housing markets, where you have to have 20% down if you're buying over $1 million. And what they're doing is actually kind of smart, because it's leaving the smaller markets like the Saskatchewans and the Calgarys and the eastern provinces basically less impacted, because a 5% reduction in what you qualify in those markets for with an uninsured mortgage isn't necessarily as big of a deal. Now, here's the key thing that the news outlets have kind of pointed this out, but not really. This is for uninsured mortgages, so more than 20% down. There's actually 2 stress tests in Canada. The first is the stress test with respect to uninsured mortgages, and the second is a stress test with respect to insured mortgages. Now, for insured mortgages, it's still that benchmark rate, which means people who are buying with less than 5% down and with less than 20% down and are buying under that $1 million mark, guess what? They're still qualifying at the benchmark rate as of right now, unless the finance minister changes this. They're still qualifying at a lower rate than what that benchmark rate would be for uninsured mortgages. So what this does is it's actually going to give those insured borrowers buying under $1 million, less than 20% down, with a little bit more bandwidth and a little bit more ability to purchase for higher amounts compared to those who are putting more than 20% down. Now, whether or not that'll change, whether or not the finance minister will change the rules with respect to insured mortgages, is yet to be seen. If they do, that'll be something that comes out in the budget in April here, the federal government's budget in April. But yet to see what happens there. So this proposal is open for review until May 7th. On May 24th, they'll make and adjust any changes. But you can pretty much rest assured that as of June 1st, we're going to see a benchmark rate for uninsured mortgages of 5.25% or 2% over the contract rate, whichever is greater. So, interesting news, big news for the mortgage industry today. If you are in the market for a mortgage, I get that not everybody wants to come to a place like Mortgage 360 and have us become the trusted advisor for you and have us help you get that mortgage and, weed through all of the products that are available, all of the rates, and make recommendations. Some people just want to do it by themselves. And I'm honored for those people who want to come to Mortgage 360 and get the information and have us guide them through the process. But I also realize that for those of you who don't, there needs to be some sort of avenue to give you the information that we have that comes with 18 years of doing mortgages, so that when you're negotiating with another broker or you're negotiating with a bank, you are well prepared. So what I've done as part of my why to inspire people to thrive and give back is I've created a course for people who want to go at this alone, the do-it-yourselfers, who just want to get that mortgage and make sure that they're the ones that are doing all the negotiating and leaving no stone unturned. And what this course is it is secrets to getting the lowest interest rates in Canada. It has all kinds of things like how much profit there is available to negotiate in a mortgage and how much you can actually get somebody to buy the rate down. It has information on how to negotiate with a broker, how to negotiate with a bank, the things that are negotiable and the things that aren't negotiable. And this course, I truly believe, will get at least 10 times what you pay for it back if you were to purchase it. And for a lot of people, you're going to get 20 to 30 times the cost of the course back in the amount of savings that you get from being able to negotiate the lowest rate and being able to better negotiate your mortgage by yourself if that's what you choose to do. So if you're watching this video, I am going to extend an offer to you to get 50% off the price of that course. You can use the discount code in the description below. It's going to be OSFI, which is OSFI. Click the link, put in that discount code, you'll get 50% off that course. And whether you choose to have a company like ours help you through that process or you choose to go it alone, my big thing is I want to make sure that you have all of the information, and not just the information that I can provide on the YouTube channel here, but also the information, the things that I can't say publicly, the secrets to actually getting a mortgage, the things that if I said them, I would have the entire industry on my back because I was telling people exactly where to find the lowest interest rates, what websites to go to, and what exactly was negotiable. So if you want to take advantage of that, by all means, go ahead. If you would like to apply through us directly, by all means, that's okay too. And the comments section is always open. So if you have questions or comments, go ahead, leave them in the comment section below, and we'll see you on the very next video. Before you go though, do me that favor, hit that subscribe button, hit that notification bell, and please, so more people like you can see this video, please hit that like button. Cheers.